So guys, in the previous class, we spoke about options, right? In the options, we have seen types of options, put option, call option. And also we discussed when we will exercise this put option, when we will exercise this call option. And we have seen moneyness concepts, in the money, out the money, at the money, and the relationship between the strike price and spot price. And we understood the premium, what is the strike price, spot price, what is the exercise, expiry. So all these things we discussed, right? And also we spoke about American European option, American option, and pyramid options. And now we are going to talk about swaps. Okay. So guys, swap is nothing but exchange. Swap is nothing but an exchange. What exactly we are exchanging in this swaps contract? We will exchange the cash flows. Swaps is nothing but it is also a contract. It is also contract to exchange cash flows. Why do we need to exchange cash flows? How it will work? If you're exchanging cash flows, suppose let's say for a I'll give you 1 lakh, you give me 1 lakh. That is also one kind of exchange of cash. You give me your car, I'll give you my car. We are exchanging cars, vehicles. That is also swaps contract. But how exactly it's going to work, sir? Suppose if I'm giving 1 lakh, another party is also offering same 1 lakh. How it's going to work? Let me tell you one thing. Everyone will have a comparative advantages. You know what is the meaning of comparative advantage? Do you know this meaning called comparative advantage? Hello?
Sir,
Do you know the meaning of comparative advantage?
no,
No.
sir.
Okay. So basically, each one will have one advantage in their market. We suppose we are in Andhra Pradesh. Maybe we have uh, what we can get it very cheaper at Andhra Pradesh. Let's assume the same financial terms itself we will discuss. I have a comparative advantage with HDFC Bank. HDFC Bank. As a person, Mahesh, I have a comparative advantage in the HDFC Bank. The comparative advantage means without any much effort, I can take some loan from the HDFC Bank. That's my advantage with the HDFC Bank. And another side, there is a person, Harish. So Harish have a comparative advantage with SBI Bank. Okay. Harish can get a loan from SBI Bank easily. Even I can get a loan from HDFC Bank easily. These are my comparative advantages. But I don't want to get a loan from the HDFC Bank. I need a loan in SBI Bank. Similarly, Harish don't want to get a loan from SBI Bank. He want to get a loan from HDFC. Suppose directly if I go and if I ask SBI Bank, I cannot get a loan because I do not have that much what do you say favorable situations with the SBI Bank. I may not be able to access the loan from SBI Bank due to some difficulties. Similarly, Harish also may not have a possibility or a easiness to get a loan from the HDFC. So both parties have some difficulties and both parties have some advantages in their respective markets. Understanding? Hello?
Yes, sir. Yes, sir.
Is everyone following?
Sir. Yes.
I have a comparative advantage in HDFC Bank. In HDFC Bank, easily I can get a loan. Harish can get a loan in SBI Bank. But we don't want to get loans in the respective banks. I need a loan from SBI Bank only. Harish need a loan from the HDFC Bank. In this case, what we can do? Let's Harish take a loan
Exchange.
from let's take a
Exchange.
Harish will take a loan from SBI Bank. Harish will take a loan from SBI Bank itself.
Yes,
Maybe
sir.
I'll also take a loan from HDFC Bank. Both parties are taking a loan from the respective banks. But I will pay Harish bank EMI. Harish will pay my bank EMI, my loan EMI. We are not actually exchanging the cash flows, but we are getting a loans in the respective banks. But I'll be paying SBI bank loan. Whatever the Harish got a loan, that loan amount I'll pay. Harish will pay my loan with the HDFC Bank. So this is how we are exchanging the cash flows between two parties in order to get the comparative advantage. It can be in the borrowing, the currency exchange, or it can be in the shares market, wherever it is. Each person will have a different advantages in the different markets. In order to acquire those markets, both parties will get a benefit through this swaps contract. We can reduce the what do you say accessibility of markets. If there is any difficulty in accessing the market, if there is a difficulty in accessing the products in different markets, using this swaps contract, we can manage it. For that purpose, we use this swaps contract. Basically, it is just a exchange cash flows. But again, we are not actually exchanging. Exchange means what? Harish should borrow the loan from SBI Bank. Let's say he's borrowing from 10 lakhs. Even I borrowed from HDFC Bank 10 lakhs. We are not exchanging cash flows. What we are exchanging, instead of exchanging this actual cash flows, what actually we are exchanging, what actually we are paying?
EMIs.
EMIs. So EMI is nothing but interest amount. Principal amount will be there. So on that, principal amount plus interest amount will be paid to each other. In layman terms, just for your understanding, I'm telling you. Understanding everyone? So what is this principal amount, sir? And then what is the role of this principal amount? The principal amount is just a notional amount. We call it a notional value.
No.
Notional means just for a contract purpose, we will account that value of a contract, 10 lakhs. But actually that is not exchanging between two parties. We are not exchanging. Instead of exchanging cash flows, what exactly we are exchanging? The interest part, the principal part of loan, we are exchanging. Not even principal part, only the interest part will be exchanged in majority cases. That is called swaps contract. Now we understood?
Yes, sir.
Now we have different types of swaps contract. We will see those types of swaps contract. IRS, interest rate swaps, and we have credit default swaps, CDS, and cross currency swaps. And we have total return swap, and we have a COD, contract for differences. Contract for differences is a different contract. Again, it is also part of derivative. I'll talk about it. Contract for differences later. But basically, these are the types of swaps contract we have: interest rate swaps, CDS, cross currency, and TRS swaps, total return swaps. Now we'll understand one by one. Okay, just give me a minute. First one, I'll talk about IRS, interest rate swaps. We call it as a plain vanilla swap also. Interest swap is nothing but plain vanilla swap. There is another name for the same interest rate swaps, plain vanilla swaps. I'll tell you how it is working. Okay. Suppose the same example. Here I am taking the same example. Okay. I have a loan from HDFC Bank. Okay. Harish have a loan from SBI Bank. Maybe I'm having a loan with HDFC Bank as a fixed interest rate. What?
Fixed interest.
Fixed interest. You know what is fixed interest rate? What is fixed interest rate?
Yes.
Interest is fixed throughout the premium.
The
paying
interest
term.
rate on the loan amount will be the same throughout the lifetime of the loan, throughout the tenure of the loan, interest rate will be the same. But there is another type of loan which is a floating rate interest. Let's assume Harish is having floating rate interest loan. Floating rate loan. So in this floating rate loan, depends upon the interest rates in the market. Depends upon the inflation and all, interest rate will be keep on fluctuating, right? So as per the interest rates in the market, the loan amount interest also will be fluctuating. That is called floating rate. Okay. As a fixed interest rate, what I assume when I'm taking the loan, I'll assume that maybe in future interest prices will go up in the market. So because of the inflation, whatever the reasons, even if interest rate is increasing in the market, still I should pay the same interest so that I'll get a benefit. That's why I might went for the fixed interest rate loan. Isn't it or not?
Yes, sir.
Why we have to take this in fixed interest rate, we'll understand from that perspective first. Why we'll go for the fixed interest rate? Maybe there is a fluctuation. They may increase the interest rate also in future. Why should I pay the extra interest if they increase it? That's why let's go for the fixed interest rate. That was in my mind. That's why I went into fixed interest loan from the HDFC Bank. Harish considered in a different way. He was thinking like maybe in future interest rate will reduce. Interest rates will reduce.
Reduce.
So at that time I can pay less interest only, right? If it is a fixed every day, every month I'll be paying, every year I'll be paying same rate of interest. It can be 3%, 2%, 10%, whatever it is, I'll be paying same interest. That is all fixed. But floating means suppose while I'm taking a loan, the interest rate is 5%. But what I'm expecting, maybe in future it may went up to 3% or 4% also. In that case, I can pay only 3%, 4%. I don't need to pay 5%, right?
Yes, sir.
But if it is a fixed rate, suppose while borrowing, the interest rate is 5%. Every year you have to pay 5% only. Whether the market is 3%, 2%, 1%, 10%, whatever it is, 5% only I have to pay. But my assumption was 5% may increase up to 6%, 7%. That's why in order to avoid that risk, what I went for the fixed
Fixed
rate.
interest rate.
Again, the floating rate, what I was expecting, as Harish was expecting, he expected that interest price will go down.
Interest rate is
I can pay lower interest.
reduced.
That was the expectations. But maybe after 2 years, after 2 years,
2 years.
I found that again interest rate will go down. My expectations is rates will reduce. Rates will reduce. If interest rate will reduce, am I going to get a profit or loss with the fixed rate loan?
Loss.
Loss only, right? Suppose if I'm expecting that interest rate will go up to 3%, already I'm paying 5%. If interest only even if it goes to 3%, still I have to pay 5% because I'm having floating rate, a fixed rate, right? So in fixed rate, I have to pay fixed rate of interest. So I'll get 2% loss. What Harish is expecting, he's expecting in a different way. Maybe he's expecting like interest rate prices will go up. His expectation is rates will increase. He's expecting that interest rate may increase up to 8%. If interest rates increase up to 8%, he will get a profit or loss.
Loss, sir.
Loss only, right? Because if it goes to 7%, 8%, he has to pay the respective rate of interest. So what we are thinking that from Mahesh perspective, I'm thinking that I better to have floating rate interest. So that even if it went to 3%, 2%, I'll pay the 2%, 3% only. Harish perspective is if I can have a fixed rate interest loan, I can pay only the fixed rate of interest rate. Even if interest rate increases, I'll pay fixed rate of interest. I don't want to pay excess amount, excess interest. Are you guys understanding the point?
No, sir. 1 second.
Mahesh is having fixed interest rate.
Yes, sir.
If interest rate increases or reduces, how much interest I have to pay?
5%.
5% only, right? But what I'm
Yes,
expecting, interest rates will reduce in future. That is my
Yes, sir.
expectation. So if interest
Yes,
rate will
sir.
reduce, will I get a profit or loss?
Profit, sir.
I'm having fixed rate interest.
Yes, sir.
Every year you will be paying 5%, 5% fixed only, irrespective of the market interest rate. Every year you will be paying fixed percent, 5%, fixed rate interest 5%.
Yes, sir.
But interest rate will reduce to 3%.
Upper loss, sir.
You will get a loss, right? How much loss you will get?
2% loss.
2% loss. Your damn sure definitely interest will go down.
Yes, sir.
Definitely you will get a loss 2% because if I could have a fixed floating rate interest, I could have saved some interest amount, right?
Yes, sir.
As per the rate available in the market, I can pay that amount, the same amount of interest. It can be 2% or 3%. Because of I'm having a fixed interest rate, I'm paying a fixed percentage called 5%. I'm getting a loss here. Similarly, Harish is having floating rate loan.
Yes, sir.
As per a floating rate loan, if interest rates reduces, he will get a profit. But what if interest rates are increasing?
Loss.
He will make a loss because definitely he has to pay more interest rate. He will also think, right, if I could have a fixed rate, irrespective of changes or increasing in interest rates, I could have paid only the same percentage, 5%, 5% every year. But because of this floating rate, I may have to pay the floating interest rate. It can be 8%, 10%, 3%, whatever it is, I have to pay the floating rate interest rate.
Yes, sir.
And this is going to cause a loss for the Harish. Getting the point?
Yes,
Yes,
sir.
sir.
Yeah. Now, everyone is in a different perspective. Mahesh is expecting that interest rate will reduce. So I am expecting that I should have a floating rate loan. Harish is expecting that interest rate will increase, so that he better to have a fixed rate loan.
Fixed rate.
He is expecting fixed rate, I am expecting floating rate. But I don't have a floating rate. Even he don't have a fixed interest rate.
Fixed rate.
His bank, their banks are not allowing. Then what we can do? We will exchange
Yes.
his cash flows.
Exchanges.
We will exchange this. What we are going to exchange? We are not going to exchange any loan amount. Like you got 10 lakhs loan, right? Give me the 10 lakhs. Take my 10 lakhs. We are not going to exchange any cash flows. Simply we will enter into an agreement. What is that agreement? You will pay my interest rate as per the floating rate. Mahesh will agree to pay interest of Harish as per the floating rate. Now Harish will agree to pay Mahesh loan as per the fixed rate. Only the interest amounts are agreeing to pay each other. Understanding everyone?
Yes, sir.
Everyone.
Yes, sir.
Yes, sir.
This
Yes,
is
sir.
called interest rate swaps. We are exchanging the interest. Swap is nothing but exchanging. Swapping అంటాం చూస్తున్నారా? Swapping is nothing but exchange. What we are exchanging? Interest rates
Interest
we are
rates.
exchanging. Why we are exchanging these interest rates? To
There is
reduce
a.
the risk in the interest rates.
Yes, sir.
To reduce the risk in the changes or volatilities in the interest rates, in order to avoid that risk, we are entering into the interest rate swaps. Everyone understood now IRS concepts?
Yes, sir.
Yes, sir.
Yeah. Now we will see cross currency swaps. Cross currency swaps. So cross currency means it's basically exchange of principal and interest in one currency for the same in another currency.
Mahesh, for principal amount should match, right? For to execute swap,
Sorry, come again.
principal amount should match, right?
Not required.
Okay.
How exactly it will match?
Now, what are the conditions to execute swap? Okay. Is there any
Basically,
conditions?
there will be certain reference rates. Based on the reference rates only, interest rate swaps will be exchanged.
Okay.
Okay, swaps contract. It's not required to have a same amount. It doesn't mean that there is no logic at all, right? Suppose I may have a 10 lakhs loan, you may have a 12 lakhs loan.
Yeah.
Normally, if you are taking a loan, no one will assume, right? Definitely in future we will get the interest rate swaps. We will enter into interest rate swaps. So let's check with others how much they are borrowing. We can also borrow the same amount. It's not like that. Whatever,
Okay.
there will be certain amount of principal amount.
Okay.
Based on the principal amount. Maybe as principal amount, we will fix it as a 10 lakhs for both. Maybe Harish might borrow 15 lakhs or 20 lakhs also. But as a notional principal amount, I'm fixing it only for 10 lakhs. Only for the 10 lakhs interest amount will be settled each other.
Okay. Okay. Okay.
Okay.
Mm.
Even if you talk more, we are not even exchanging the entire cash flows. For your understanding purpose, we are talking like that. Maybe Mahesh have to pay 10,000 interest. Harish have to pay 8,000 interest. There is no point, right? I'll give you 10,000, you give me 8,000. There is no
Yeah.
point, right? What they will do? Mahesh only will pay 2,000 balance to Harish. That's it.
Okay.
Only the difference amount between these two interest rates will be settled. Not
Okay.
even the exact interest rates. In that way, it will work. But for our
Yeah.
understanding purpose, we are talking like Mahesh will pay floating rate and Harish will pay fixed interest rate. But actually, in real time, the difference between these two exchanges will settle.
Fine. Fine. Okay.
Getting the point?
Yeah, Mahesh.
Yes,
Fine.
sir.
Then we are talking about the cross currency swaps. Cross currency swap means again here also the same. Let me write it an example so that you'll understand. Okay. Suppose there is a company D. Company D. Okay. Suppose it is available in the USA. The company D is then situated in USA. They have to pay. Their company D has to pay. It needs to pay another company. Another company in European dollars, in euros. Okay. As the company is in USA, they may have regular transactions in US dollars, right? But they have to pay some amount to some other company in euros. Getting the point?
Yes, sir.
If you see the interest rates, I mean, sorry, currency exchange rates for US dollars and euros, there will be like 1.7 US dollars equal to 1 euro or something. If you see the interest rate, let me share this. We'll see the rates. USD2. Can you see this? If you spend $1, if you spend $1, you will get only 0.93 euro.
93 euro.
You're not even getting a full dollar, full euro dollar. You're getting only 0.93. If you want to get 1 euro, you have to pay more than 1 US dollar. Maybe this price will increase in future also. It went up to like suppose let me do it in a different way. Euro to US. Yeah. How many US dollars you have to pay for 1 euro?
1.07.
1.07. But what your US company is expecting, after 1 year I have to pay this amount. 1 year I have to pay some amount to another company in euros. After 1 year, this 1.07 may increase up to 0.2, 0.3 also, right?
Yes.
It is just in a 1.07. But in future it may increase up to 1.3, 1.5, $1.5 also you may have to pay in order to get 1 euro. That means the currency between a euro and US is going to be unfavorable. Understanding?
Yes, Mike.
Yes,
Yes.
sir.
This is the currency, guys. Euro to USD. This euro to USD is it's going to be more unfavorable. That means the European dollar will have value, European pound will going to increase, and US dollar value is going to decrease. So that if you want to settle the amount in euros, you have to spend huge dollars. It's going to be unfavorable for the US company. So for that reason, what they're doing, they will enter into one cross currency swap with the company E. Let's assume they're entering into the cross currency swap with company E. Company E. What is that contract? Company will pay to the company E interest at a fixed rate. Suppose let me write it here. Company D will pay company E interest at fixed rate. Let's assume 1 euros, euro million. Okay, here also they have to pay. Let's assume they are trying to pay 1 euro. They have to pay to another company as a 1 million euros they have to pay. Okay. So now they're agreeing, they're entering into a contract company with E. So what is that contract? Company D, which is a US company, is going to pay company E interest at a fixed rate. For how many rupees? How many dollars? For 1 million euro dollars. For 1 million euros, they're agreeing to pay fixed rate. Okay, again, company E, the same contract, company E will pay company D interest. Company D interest in a company D interest at a fixed rate, which is equivalent to equal to 1 million euros. So in this contract, they are going to enter. So company D will pay some amount of interest to the company E. This is basically company E interest. So they are agreeing to pay 1 euro million because they have to pay to another subsidiary company 1 million, right? So if I continuously paying this company E interest at a fixed rate for 1 million, what I'll get in return? If I'm paying company E interest, in return, what I'm expecting?
dollars.
Are you understanding the example, or do you want me to repeat it again?
Sir, I cannot
Repeat
understand.
it again. Sir, repeat it once again.
Let me write it very clearly. There is a swap contract between two companies. What are the companies?
D and E.
Company D
D
and
and euro.
company E. This is a contract, okay? Company
Yes.
D is which based company?
US company.
US based.
US based.
And company E is based on Europe.
Euro.
Okay. And principal amounts. Principal amount. So both parties, company D and company E, agree to swap their principal amounts. Swapping is nothing but exchanging. So they agree to
Exchange.
exchange their principal amount. But the principal amounts are in a different currencies. Company D is in US currency, company is in Europe currency.
Euro.
Okay. So now, how they're
Yes, sir.
exactly exchanging that cash flows, we will see. Okay. Currency and principal exchange. Now, company D will borrow 1 million, which is in euros. Borrow 1 million
Euros.
from company E. Company is the European company. So they're borrowing in a euros. Getting the point?
Yes, sir. Yes, sir. Yes, sir.
Company E will borrow
1 million.
how much?
$1 million.
They have to $1 million in what? Equal amount.
From company.
Equal.
Equal
Yes, sir.
amount
Equal amount to be
of 1 million
1 million
euros
from
in
company
USD.
D.
In USD dollars.
Yes, sir.
From company D. Understand, guys, clearly? Company D.
Yes, sir.
Company D is borrowing 1 million euros from company E. If 1 million euro means what is the same amount in USD dollars? How much? Suppose it's a $10 per. Let's keep it as a $10. Even instead of they're borrowing $10, 10 euros from company. The same, the equivalent amount of $10, they are going to borrow in USD dollars. $10. So what would be the US dollars per 10 euros as per this exchange rate? How much?
10.7.
Yes, sir.
10 into 1.07. 10.7.
10.7.
So 10.7 US dollars they are borrowing. Who are borrowing? Company E is borrowing for
Company.
company D. Why is that? They are paying only 10 euros, but they are borrowing 10.7 USD. Why? Because of the exchange rate. Your 10 euros is equal to 10.7 USD
10.7
dollars.
USD dollar.
Everyone understood?
Yes, sir.
Everyone understood up to this point?
Yes, sir.
Yes.
Okay. Now, interest payment. How they actually exchange interest payments? Company D agreed to pay company E interest, company D interest on 1 million euros. I'll say $10 only. Let's keep it as $10. 10 euros. This is what company D is accruing. Understand this point very clearly. Company D agreed to pay company E interest. Company D borrowed how much?
The 10
10.7.
10 euros only, but which is equivalent to 10.7 USD.
10.7.
10.7 USD.
10.7 USD. But what company D is agreeing? I'll pay your interest. How I will pay?
Yes, sir.
Not in US dollars, in euro dollars. You borrowed 10 euros, right?
Yes.
So
Yes.
company D will pay company E interest for only 10 euros. At what rate? Fixed interest rate. At fixed rate. This is what company D is agreeing. Now company E also agreed. Company E agreed
Agreed
to pay company
company D
D interest. Company D interest
interest
in euros or USD?
In
the
USD.
USD.
In USD only. Are you guys understanding now? Company E agreed to pay company D interest again in the USD dollars. Getting the point, guys?
Yes, sir.
Now, let's see the result actually. If company if exchange rate increases our expectations, we will see the rate exchange expectations. Rate expectations. Okay. What company D is expecting in future, the euro and USD dollar exchange rate may move against to its favor. That means it may increase more than 10.70, 1 point, here we have 1.07, right? It may increase in future. It may increase in future. So for that reason, what I'm paying fixed rate. Even if it is increasing, I'll be paying fixed rate, right? Here see, they're paying fixed rate.
Yes, sir. Yes, sir.
Here they're paying fixed rate. Whatever the interest you are paying, for the same amount, I'll pay it in the USD dollars. Company is paying in the USD dollars. Understanding? Company D expectation is this exchange rate will increase in future. That's the reason to pay that amount of euro interest in a fixed rate. For the same amount, they're getting
Yes,
the
sir.
USD interest as well. There is a loss if it increases. There is a loss, but in order to avoid that interest increasing, what they're entering into that, they're entering into the fixed rate. So whatever the amount you
Yes,
pay
sir.
as per the fixed rate, you will get the same amount in return for the USD dollars, right?
Yes, sir.
That is the contract between swapping of currencies. It is also borrowings, loans, and interest rate only, but it is in a different currencies. We're exchanging for the fixed or floating, whatever it is, but in a different currencies. Here, what is the purpose entering into this currency swaps contract? Why D is entering into the currency swaps contract?
USD.
Huh?
The exchange of monies principal.
Yeah. Fixed interest means both companies know their payment obligations before itself. But In order to avoid the loss due to exchange rate increases, they are entering into this contract. Each company can secure a better interest rate, right, through this contract to achieve some independently in the local markets. They are entering into these two contracts. That is the purpose of having cross currency swaps. It is also exchanged cash flows for the interest rates only, but it is with the different currencies. We will pay one interest rate in a different currency, and we will receive the interest amounts in different currencies. The principal amounts are in different currencies. The interest payments also will be receiving in a different currencies. Understanding now?
Yes, sir. So,
Everyone understood? Everyone, guys?
so
Yeah. That is called cross currency swaps. Now we will see TRS, total return swap. It's very simple. Total return swap means without holding any asset, without holding any asset in our hand, we will expect some interest or we will expect some returns on that asset. How it will work exactly? We will see one more example so that you will understand. Okay. Let me take a simple example for the total return swaps. One second. I have an investor A, and we have a bank as well. Let's assume bank is a B. As an investor A, I don't want to purchase any stocks directly in the stock market. I don't want to purchase any stocks in stock market, but still I want to get a returns. I want to get a returns on the stocks. How I will get a returns in the stock market? Suppose if I am holding some TCS shares, how I will get a profit?
no, ma'am.
Stock price.
TCS company will pay some dividend, right, on a share.
Yes.
So that dividend I'll receiving on a yearly basis. That is the return. But if I'm holding that share with purchasing, I'll get that return. But investor A is expecting without holding that asset. I don't want to purchase any stock, but still I want to get a return on that. Okay. What company B is doing? Company B holding that share. Company B in the sense, sorry, bank B holding TCS shares. Bank B is holding TCS shares. And bank B is ready to share the profit of TCS shares. Profit of TCS, or we can say return on TCS shares. What is return on TCS shares? You can say dividend, right? Dividend. So whatever the dividend will be receiving by the TCS shares, bank B is holding actually. Who should enjoy the returns on the TCS shares normally?
The people who holding the shares.
So bank B is holding. So normally bank B should enjoy the profit. I mean the dividend. But what bank is doing? Bank B is ready to pass this return to someone else. This is a benefit return. But bank is ready to transfer this benefit to someone else. Is everyone getting the point? Bank B holding TCS shares. If TCS is announcing some dividend, who will receive that dividend?
Bank only.
Bank only.
Bank
But
B.
what bank B is saying, I'm ready to pass this benefit of TCS share to someone
Share
else.
the dividend.
Yeah, I'll receive some dividend, right? I'm ready to give it to someone else. In that way, I'm ready.
Okay.
So they are entering into an agreement. Now we will see that agreement. Okay. They're basically the swaps, how exactly this will work on, we will see. What is the asset in this case, in this contract? What is the asset?
TCS
TCS
shares.
shares.
TCS shares.
Yes, sure.
TCS shares is the asset. So they are entering into contract for a purpose. What is the purpose? Investor A, Investor A. So investor A agreed to pay some fixed interest rate to the bank B. Investor A is agreed to
Some fixed.
pay fixed rate. Let's assume he agreed to pay 5%. 5% on 1 lakh. 1 lakh rupees. Okay. Now bank B is also holding 1 lakh TCS shares. Here we have a TCS shares, right? Let's assume this worth of this TCS shares is also 1 lakh. Okay. Now they are entering into one contract. What is that contract? Investor A will pay 5% fixed interest rate to
1
bank
lakh.
B. For how much? How much?
1 lakh to
1 lakh.
bank.
Bank B is also holding 1 lakh TCS shares, right?
Yes, sir.
So every year you will pay 5% interest on 1 lakh. Whatever the return I'll be receiving on the TCS shares, I'll give you this return to you. Maybe TCS shares can pay 10,000 return, 10,000 dividend. I'll give you this 10,000 return. It can give 30,000 dividend also. I'll give you this 30,000 dividend also. Whatever the dividend I'll be receiving from the TCS shares, I'll send you this dividend to you. But every year, what you have to pay?
Fixed.
Fixed 5% you have to pay.
Yes, sir.
So what is the advantage of A? Without holding the TCS share company, by paying a fixed rate of fees to the company B, sorry, bank B, I'm enjoying this 30,000 dividend. So whatever the return generated by the TCS shares, I'm going to enjoy the dividend. I'm going to enjoy the return, but I'm not holding the TCS shares. In return, what I'm paying? I'm paying 5% fixed interest rate. Getting the point?
Yes, sir.
Mahesh.
This is called total return swap. The concept of total return swap is without holding the asset. Without holding the asset, but still I'll enjoy the return on that asset. Without holding the asset, if you want to enjoy the return on that asset, we can enter into this total return swaps, TRS swaps. So with this TRS swaps, we can go and we can enjoy the returns by paying some fixed interest rate to the banks or some other
Bank B.
companies. Yeah, bank B, we will enjoy the return. Suppose if TCS company is paying only 1,000 dividend, in this case also you have to pay 5% only. For 1 lakh 5%, how much it is? 5,000. So every year you have to pay 5,000. Maybe first year you got dividend only 1,000. Maybe second year you may get dividend 5,000. Third year you may get dividend up to 10,000.
10,000.
So whatever the dividend you will be receiving, the same dividend will be transferring to investor A. But bank B will get always 5,000, 5,000, 5,000. Every year they will get 5,000 because it's a fixed interest rate, right? So they will get 5,000, 5,000, 5,000 as per the 5% interest. This is called total return swap. Understood, everyone?
Profit రాకపోతే సార్.
Sorry?
There is no profit అయితే సార్.
To whom? ఎవరికి
సో
ఎవరికి ప్రాఫిట్?
అంటే ఈ బ్యాంక్ కి ఇప్పుడు చెప్పారు కదండి సార్ 1 lakh 5 lakh అది 1,000 5,000 10,000 అట్లా అలా ప్రాఫిట్ రాకపోతే ఇన్వెస్టర్ కి ఏకి లాస్ కదండి సార్.
ఇన్వెస్టర్ కి yes, it's loss only.
ఓకే సార్.
Basically the contract purpose is you don't want to hold any shares, you don't want to hold any investments, but
Okay,
whatever
sir.
the economic benefit I'm going to receive on that share, on that asset, I'll transfer that amount.
ఓకే సార్.
But every year you have to pay fixed rate of interest for me.
ఫిక్స్డ్ రేట్ ఆఫ్.
Yeah, if you want me to transfer that amount, you have to pay fixed rate of interest for me. Understanding?
ఎస్ సార్. ఎస్ సార్.
Now we will see another type of contract which is called CDS, credit default
sir.
swaps. This is also a bit tricky. This is just like insurance, taking an insurance. You heard about this junk bonds, angel bonds, right? When we're talking about bonds, bond market. What is the junk bond? Angel bond, junk bonds. We spoke about it, right? Hello?
Yes,
Hello?
Mahesh.
Yeah, tell me. What is junk bonds? What is angel bonds?
Angel bonds is a
Junk
Huh?
bonds means we'll get low credit
which
rate, but
has
we'll receive high interest.
Junk bonds means we will receive high interest. Why we will receive high interest?
Got yes.
Hmm? What is it?
Big pay.
Why it's paying high interest rate?
But
Your voice is breaking now. Manasa, what is junk bond? Hmm? Why it will pay more interest rate? Jayshi,
Yes, Mahesh. It is a
what
high
is
credit, low interest.
high credit?
Low credit rating.
It's having actually low credit rating. Companies having low credit rating will issue
High
bonds with a
interest
higher
rate.
interest rate. Angel bond means company will have high credit worthiness and high credit rating, will issue bonds for the low interest rate. But there won't be chances for the default. That's the reason they will offer only less rate of interest. But in case of junk bonds, they may have high chances for the default in terms of payment interest as well as principal amount. So for that reason, they will pay higher interest rate to attract the investors. Okay. Now let's come back to the same concept here also. Let's assume we have an investor here. Okay. Investor X we have. So investor X purchased buying a bond from company Z. Company Z for 1 lakh. How much? 1 lakh worth bonds. They're purchasing for 1 lakh worth bonds. But after purchasing for a few days, the investor A is concerning about the default. He is expecting that company Z may get default. Company Z may get default, but he's already holding a bonds in company Z for 1 lakh. Let's assume the maturity period is for 5 years. After 5 years, he will get that 1 lakh rupees. Every year he will receive interest amount as well.
interest rate.
Okay. In this case, what is the asset? In this case, what is the asset?
Bond.
Bonds, right? Bonds of company Z. Company Z for 1 lakh. This is
Z.
the asset. This is the asset category. But what X is concerning? His concern is the possibility of company Z defaulting on its debt. Maybe company Z started getting a huge losses. You know, right? As a defaulter, as a loan, if company goes to liquidation, you don't receive the entire amount. There would be chances to get a default from the company side. In that case, you don't get the entire 1 lakh. So he's concerning about his amount. Already invested 1 lakh. He need to get an insurance for that 1 lakh. He need to get an insurance for this 1 lakh. Guys, keep it on a mute. How, sir? Even on debt capital and bonds also can we get insurance, sir? Yes, we can get an insurance. That is the concept of credit default swaps. In the credit default swaps, we can get an insurance on the debt as well. Suppose you are transporting some goods from one place to another place. Why will take an insurance on that transporting goods? If goods are getting damaging in the transportation, there will be insurance coverage. That is the purpose of getting insurance, right?
Yes, Mahesh.
If you are
Yes,
transporting
sir.
goods from one place to another place, what is your asset? The goods, whatever you
Goods,
are transporting. It can be bike or car, whatever it is. Why you are taking insurance? You
If
have a
any
chances.
damages
If
appear,
any
make the
accident
insurance
Yeah.
money
any
for this.
damage, they claim the insurance.
You have chances of losing your asset. Even if I lose my asset, at least from the insurance company, I should get an insurance coverage. That's the reason you are going for the insurance, right? Here also the same thing. You have a loan. What is that loan? Bonds worth 1 lakh from company jet. Here also you are getting the same tension. Like you have a possibility for losing this 1 lakh asset because of the defaulting issue from the company jet. Now what you are taking? You are going and taking on insurance policy. You are going and taking one insurance policy. So let's assume you're taking some insurance from company Y. From company Y. If you're taking some insurance policy, the bond period is 5 years, right? Bond
Yes,
period is 5 years.
Yes.
If you are paying some insurance, how you will purchase this insurance? Suppose you are taking some life insurance for 10 years or 20 years. Every year, what you will pay?
some amount.
What is that amount?
1 lakh.
Huh?
Premium.
Premium, guys. You know about the premium? Insurance premium.
Yes, sir.
ఎక్కడ వినలేదా?
Yes, Mahesh.
Premium is nothing but periodical amount. Whatever the insurance policy you have taken for 1 lakh or 2 lakhs, like that you will take some insurance. Portion of that insurance policy every year or every month you have to pay. Here also we're taking some insurance. For that you have to pay premium. What is the premium? Maybe 2% of asset value. Let's assume it as a 2% of asset value. What is the asset value? 1 lakh.
1 lakh.
And 1 lakh, what is the 2%? 2,000.
2000.
2,000.
2,000. So every year you will be paying 2,000 rupees, 2,000 rupees.
Yes, sir.
So every year investor has to pay 2,000 to the company insurance Y. And the defaulting event. If company Z is going for the default, if company Z is getting defaulted, then what he will do?
They claim the insurance.
If company fails to pay interest amount, or if company Z fails to pay some interest amount on a yearly basis, company Z should pay interest, right? Investor A, X. If company Z is not paying interest amount, and after 5 years, company Z is not paying this 1 lakh rupee amount also, which is the principal amount. And maturity date, company Z should repay this 1 lakh rupee amount also, right? But they're not ready to pay. In that case, company Z defaults. In this case, company Y, which is an insurance company, company Y will pay that amount to the investor X. Why company Y should pay that?
Investors.
Why company Y should pay? They borrowed bonds from the company Z, right? Why company Y should pay to the investor X? Why company Y is paying? Why company X should pay?
You have taken insurance.
It's an insurance company, pa. From the insurance company only we took insurance, right? If the purpose of insurance is, I have a doubt on the company Z, they may go for the default. Even if they go for default, I need my 1 lakh rupee amount. So for that reason, I'm entering into the contract with company Y. I'm taking an insurance policy. If company Z goes to liquidation, I have to get my 1 lakh. For that reason, I'm entering into the insurance contract. I'm paying 2,000 premium every month. So at our first year, I found company Z went for default and therefore liquidation. Now I need my 1 lakh rupee worth as an insurance policy coverage. That is called CDS. So this CDS contract is the involvement of 3 parties. Who are the parties? Who are the parties involved in this? Investor X.
Investor X.
Who is an investor? Then what next?
The company.
Yes, company Z. Company Z is a company from whom we purchased bond.
Bonds.
Then who is the next one?
Insurance company.
Insurance company.
Company Y.
Company Y. So CDS
Insurance
contract
company
is the
Y.
involvement of 3 parties. 3 parties will be involved. From 1 person, we will take a bond aside. And from another person, we will take insurance.
Insurance.
Company jet getting default, then I'll get a coverage from company boy. Okay, sir. If company jet defaults, if fails to pay interest and principal amount, I'll get coverage from company Y. What if a company jet is not defaulting? They're paying regular interest. They're paying the principal amount also after 5 years. What will happen?
Then no need of insurance amount.
So can you get back this premium amount out you paid?
No.
No.
No, we cannot. It's a cost of insurance policy. That's it.
Yes, sir.
You cannot get back this premium. It's an expense. It is a cost of premium, whatever the amount you have incurred. In order to gain some peace of mind, you have incurred. You have taken some insurance policy. That's it. Health insurance is months what? We are taking insurance for damages. If damages happen, then only you'll get insurance. If you don't get the damage, you don't get anything. And also premium on what we paid is nothing, you're not going to getting back. That's how even company Y should also survive, right? Insurance companies. Everyone understood now what is the credit default swaps?
Yes,
Mahesh.
yes, sir.
Then I have to talk about this one, contract for differences. See what? This is also one type of derivative contract, guys. Contract for differences. You know what is contract for differences? Basically, it is also just like a betting one. We talk about total return swaps, right? Hello.
Yes, Mahesh.
Yes,
So in
sir.
the total return swap, without holding any asset, we are
We
enjoying
are
the profit.
getting
We are enjoying the return on that. Similarly, contract for differences also, it is like a gambling contract. It is like just like a betting. Let me see one example. There are two traders. A is there, trader who is doing a trading. Trader A is there, and we have a trader B also. As a traders, we know, right, what they will do. They will always invest in the stocks, and they will expect the prices will go up so that we can sell assets and we can get the returns. Suppose how we normally do the regular trading. Suppose I have invested some stocks, 1,000 rupees. Let's assume I have invested like 10 shares in TCS at 120 rupees. If I'm investing, I'll expect that prices will go up. So next day, the TCS share price went up to 135 rupees. 135 rupees. So I can sell the share now. If I sell the share at 135 rupees, how much profit I'll get? I have 10
15
shares,
rupees, sir.
15 rupees profit. How much profit I'm making? 150 rupees.
Yes, sir.
Right? This is like a normal trading, regular trading. This is how normally the people will do. If prices are increasing or something, they will do the trading like this. But in this contract for differences, now we will see how exactly it's happening. Okay. Trader A is there.
Yes,
Trader
sir.
A. So he's expecting that. He's expecting that TCS share currently which is trading at same. Let's assume currently which is trading at 100 rupees. 100 rupees per share. Okay. He's expecting that prices will increase. Prices will increase. Company B is also there. Company B is also there. He's also expecting that company's TCS share will go down. Company's TCS shares price will go down. That is trader B is expecting. Okay. Now he will go and he will have a contact with another company, another party. So the broker or someone else with someone else, he will go and enter into the contract. Or else with the trader B itself, he will enter into the contract. What is the contract? The contract is the trader will agree to pay, trader A will enter into an agreement. Enter into CFD contract. We call it CFD contract, contract for differences. Listen this very carefully. With trader B. What is that trader B is expecting? I mean, the contract if TCS share price TCS share price increases, trader B should pay difference amount. Trader A is entering into the contract with trader B with a CFD contract. What is that contract? If TCS share price going above 100 rupees, if it is going above 100 rupees, whatever the difference amount we have, suppose the next day TCS price went up to 115, how much it increased? 15 rupees, right?
So 15
So there is the
rupees.
increasing of 15 rupees. Now trader B should pay 15 rupees to trader A. Suppose next day, instead of going to 115, it went to 97. In this case,
3
trader
rupees.
trader A should pay to trader B. How much?
2
3
rupees. 3 rupees.
3 rupees. But trader A is not holding any share. Trader B also not holding any share. They are not actually holding any shares. But still they are making a profit. How?
By entering into CFD contract.
By entering into the CFD contract. What is the purpose of CFD? They are just entering into the contract. For which shares? TCS shares. What is the terms and conditions? We are expecting that prices will go up. If price increase, I'll give you the difference amount. Whatever the increasing amount, that amount I'll give you. If decreasing, you will give me. That is the contract they're entering into the each other. That's we call as a contract for differences. Here also they're not holding any shares. Without holding shares, they're entering into the contract for the different amounts of price movements. It's completely a speculative business. It's just like a betting only, right? We're not holding shares. Directly we're going into one stock exchange website. Here itself, you and me also can go and enter. If you go to NSC, here itself, you and me also can go into one CFD contract. Take Tata Motors. What is the closing price? Previous closing 988. So we can also bet if tomorrow, if this Tata Motors company going beyond 1000 rupees, me and Harish will go into bet. What is that bet? If it goes more than 1000 rupees, whatever the amount of extent it is going beyond 1000, you should give me. If it is not going above 1000 rupees, if it is like 950 or something, for that less amount, I'll give you the amount. In that way, we'll enter into the contract. That is called contract for differences. Everyone understanding? Hello? So this contract, swaps contract is also like a OTC product only, not over the exchange. We discussed about OTC, over the product, over the counter, over the exchange, right? What is the OTC? What is the OTC? Jayshi, what is the, one second, Jayshi, what is
It
the
is
example,
over the contract.
example contract derivative for OTC?
Forward contract.
Forward contract, excellent. So forward contract is a OTC product, and features options are the over the exchange. Similarly, the swaps contract are the OTC product only, over the counter only. But there are few regulations. There are few bodies and not regulations. There are guidelines. There is certain bodies which have given some guidelines how we can execute the contract. Depends on the regions and countries. They have given some guidelines, framework. We call it as a framework guidelines given by few bodies. So as per those guidelines only, we have to execute this swaps contract. Now we understood. I think we have covered almost IRS, cross currency, total return swaps, contract for differences in the contract credit default swaps. These are all the derivative contracts, guys. So we have covered everything in the derivatives concept. So more than this, you won't be having any questions from the interviewers. Majorly, you may get questions about this moneyness concepts, in the money, out the money, and in the credit default swaps and cross currency IRS. That's it in swaps. In forwards and features, normally like OTC product, these kind of questions, which one is OTC, why it is OTC, the difference between features and forwards, these kind of questions you make it. That's it. Okay. Anyone have any questions? Anyone have any questions, guys?
No, sir.
So we have completed this one as well. Tomorrow I'll start with the corporate actions. Okay, very important concept, the corporate actions. We'll talk about these corporate actions. Then you can start from the fund accounting classes from 10th onwards. Okay. I'll stop sharing my screen. I'll stop the recording.